Even today, when we look at some of the things I reported, the S&P 500 is up 4% for the year. Went down yesterday, but it's up today. And people would say, wow, you know what? Things are good. It's a new bull market. The S&P closed above the 200-day moving average, which is always a good sign for technicals. So it's bringing out more and more of the bulls saying, hey, this could be it. This could be it. And then you had the producer price index came in much lower than expected, which is good news on the inflation front. Year over year was still up 6.2%, but it fell 0.5%, much lower than the 0.1% expected. And when I see some of these things and people saying, well, things are good, where copper surge, highest level in 7 months, oil's at the highest level since early December. Those are kind of bullish signs usually for markets, right? Oil goes higher in the bullish market, not in the bearish market. And people think, well, it goes lower, people spend less. So you don't really see bull markets when oil's going lower. And
you've warned about this, but why is copper getting a bid right now or recently?
You know what? There's just such a supply-demand imbalance. And you could say that for several commodities. So copper, because I cover copper companies, it's never been this wide. And it's huge. So, of course, copper is, you're looking at the economy and saying, okay, we're going to hit a recession this year, and why is it going? So there's just it's kind of like uranium as well. I mean, the fundamentals was so terrible when it comes to supply-demand, that imbalance, which favors higher prices. You just need any kind of, little demand, and it's going to set off because we just did not build up supplies in such a long time.
And to your point, some CEOs have some good things to say at the Davos. They also have some leaders. China's leader made one of China's leaders. I don't want to emphasize or assume it was President Xi. It wasn't, but it was a China leader talking about how we are reopening to the world. This grand reopening, borders are open, economy's back open. No doubt that's helping copper catch a little bit of a bid. It is now. That could be a fun conversation for later. Do you fade that? Because to your point, just because you flip the switch doesn't mean you go back to the economic that you had in 2019. There's going to be a lag there. Overall, for the markets, though, in sentiment, it's bullish than bearish.
When things were great, that's what I'm trying to explain to people. It's I don't want to pour cold water all over this, but in 2019, when there was no COVID, China peaked, right? And it was growing much, much faster than it was today. This is the peak of 2019. We were trading at like 23 times forward earnings. We had interest rates much, much lower. We did have, still quantitative easing, right? The Fed buying bonds and pushing more money into the market, still had stimulus going. So, it's a much different market now, even opening up at this level where people are like, oh, we're going to go back. What are you going to do? Go back to 2019 levels? Because if you do, that means the market should still be down tremendously in terms of earnings, right? Because we're at 240 and it was 160 in 2019 when you were fully open. That was my thesis for saying that, holy shit, this market's going to crash because we peaked at earnings and growth peaked. And then all of a sudden COVID hit and we got to jump on COVID thanks to so many people listening to this podcast and doctors and people all over the world, which is broadcast over 100 countries, and being able to interview them and say, that's why I was like, whoa, this market, I was bearish on the market. And then when you shut down China completely, which we heard in January, Apple and Levi's and Yum Brands, these companies with the biggest presence, all the S&P 500 with the biggest presence in China, were completely shutting down. I'm like, okay, if you're completely shutting down, and you look at Nike as well, that's their growth model. China is their growth model. That's what they're depending on for growth. And you're completely shutting that down at a valuation you haven't traded pretty much historically, some of the highest valuations in history outside of, 2000 when the NASDAQ was at, 40 times forward earnings before it crashed. But before, I always want to talk about both sides. I don't have an agenda here. I don't get paid by anybody or whatever. It's just how I look at the market. So, do we have some good news? We had some good news. You've seen the market go up, but be very, very careful here because there's a great stat out there where you've seen the shorts get squeezed, right? So Goldman Sachs has a most shorted basket. It's the most shorted basket, right? And it outperformed the S&P 500 by 1.8% yesterday, believe it or not, with the market's down. It's up 16% year to date compared to the S&P 500 up 4%. This is as of yesterday, right? Massive performance. And then Bloomberg came out and noted that this performance gap hits 10% plus. When that happens, it's coincided with a recent market top and basically the market falls. And this happened in March, May, and August. So we see these markets all the time during this bear market where we're seeing this whole thing come back and everyone's like, holy shit. But you're seeing that, they said that difference when it gets 10%. Right now it's over 12%. With the shorts. You've seen a lot of risky stuff go higher. In fact, Bitcoin, which is incredible, was up 14 straight days. Did you know that?
I know how much it was only because I read it this morning, and it shocked me that it was consecutive. Days. Yeah, that was wild. And it's
so funny because I'll give Coinbase credit on this day. I will. I listened to a call because I'm like, where the hell's all this money coming from? Yes, you're seeing short covering, but we're talking about $100 billion plus move, right, in Bitcoin and its market cap, which is not done. Yes, you have short covering, but you need to start the short covering. This is institutions. Retails are kind of out of this market right now. They've gotten so annihilated the past year. So I said, let me listen to Coinbase. They had like 5 guys on, all heads on, like trading department and institutional sales and this and that. And I listened. Every single one of them was like, hey, this is going to be short-lived. And I really appreciated that because you talk about Coinbase and they can go on and be like, well, we're back and this and that. And you got, they're crypto. They're a crypto company, right? That's what they are. Crypto does good. They do very, very good. When it doesn't, it comes down. And for those guys to be like, well, we're just, we pushed a little too far and they're going over a trading guy with different, 200-day moving averages and stuff like that. But almost everyone was like, look, we're going to be pulling back. And they've been saying that for a couple of days, which kind of makes me think that Bitcoin is probably going to go higher. But when it comes to the markets, this is normal in a bear market. And when I'm looking at the data itself and not just from trading perspectives, because you break the 200-day and people are like, oh, shit, we got to buy. Be careful because, again, when that short index, that Goldman Sachs most shorted basket, that's been around for a very, very long time that they provide that. And when it goes higher, you're seeing a short squeeze. Again, when that outperforms the market by more than 10%, as Bloomberg notes, it signals a top or at 12%. We're very, very close to seeing this market turn around, especially during earnings season, because we have the United and stuff like that, which is pretty good, but a lot of these companies are lower their earnings significantly into this quarter. So you're going to see 70% of the companies beat just like you did last quarter and be like, wow, earnings are okay, but they were revised 7-8% lower over the past 3 months. The highest amount that I've ever seen a revision outside of a Black Swan event, which I said yesterday. But now, Daniel, look at total retail sales, right? Retail sales got crushed, right? For 1.1% month over month. It was worse than the 0.8%. And this is after falling in November. They reported negative 0.6% in November. However, that was revised because we always have revisions when it comes to economic data, right? And then we're like, well, here's the real number. The revision for November last month is now it fell 1%. So it's almost double what they reported, which is big. Because if you reported 1% in retail sales last month, it would have been market moving. The market would have got hit pretty hard. But it's only 0.6%. Now, you look at retail sales in the middle of that, and holy cow. I mean, department stores, they said sales diving 6.6% after falling 3.2% in November. Again, this is December. This is the holiday season. Motor vehicles, parts sales declined 1.2%. This is broken down. I'm going to give you the breakdown here. Electronics and appliance stores fell 1.1% after falling in November. General merchandise declined 0.8%. Clothing accessories fell 0.3%. Gasoline sales were down 4.6%. I mean, you had sporting goods, hobby, music instruments, and bookstore sales, which is one category, rose 0.1%. Maybe a couple people felt like, all right, I'm going to be home, I'm going to buy a guitar and buy a sports shirt to hang out outside in the porch. I have no idea. Building materials, garden supplies rose a little bit after falling 3.1% in November. So, you're looking at these sales come down, and the PPI was good, right? But remember, when it comes to the PPI, prices are coming down. Companies are losing pricing power. And yes, you're going to say, well, their costs are going down, but are they? Because we're seeing oil prices now move up to the highest level since December. So we're seeing oil prices move up higher. We're seeing copper prices, again, direct input costs. A lot of these costs are starting to move higher while you're seeing prices come down sharply with the producer price index. And then finally, when you look at another negative is Microsoft. And Microsoft came out today and said, hey, you know what? We're going to lay off 10,000 employees. Guys, I don't know if you 10,000. I don't know if you realize how big Microsoft is. And if you don't, it's okay, because I really got a reminder of how big they are, Daniel, when I was at Consumer Electronics Show, because it's the first time since they released their phone, which was like, holy cow, I don't even remember when, 7-8 years ago, that they actually had a physical presence on the floor CES, and they had 2 massive booths, one in the metaverse section and one in the auto section, right? They never really have a presence there. Neither does Apple, but everybody talks about Microsoft and Apple. Microsoft is in everything. And Microsoft is the ultimate bellwether for technology. I mean, you could say Apple's there too, but we're talking about one of the biggest companies in the world, trillions of dollars in market cap, products and everything from laptops, PCs, Zure's integrated in how many S&P 500 companies? A ton, right? Along with AWS, and we're seeing weakness there. And plus they warned, or they didn't warn, but the last two quarters, they missed in cloud sales, which is their bread and butter, right? Xbox, gaming, advertising, social media, AI, right? They're across the board in every single thing. At this stage, if you really think, hey, you know what? We're good. We can see the Fed and we're fine and we're okay. At this stage, this company just said we're laying off 10,000 employees because they see it, okay? They see how much demand is so, and these guys are in everything. They're not in one particular market and saying, okay, PC sales are getting crushed. Social media is getting crushed. Advertising revenue is getting crushed. Streaming is getting crushed. Anything like that, right? Streaming, the whole streaming. They're not in any particular industry. They're in all these industries. For them to come out right now and say this, I mean, to me, it tells you, right? That's the writing on the wall. It tells you, listen, it's not going to be a good year. You're going to see the market bounce like this, and shorts, get out there and go crazy, and everybody leans to one side, and it's easy to have these short covering stuff. And maybe that's what you're seeing even with Bitcoin. And look at some of the names in our portfolio, seriously, now up 50% from their lows. Again, still down incredibly because they're down 80% and talk about the crypto portfolio. But overall, there's nothing that tells me anything is changing. In fact, a lot of these things are telling me that things are getting worse, because we all know the producer price index CPI, Daniel, has no place else but to fall. It better fall. It has to fall. Okay, that's what happens when you raise rates by the highest pace and fastest amount in the history since in the Fed era, right? So you're going to see that, and it's happening. You're going to continue to see it. Will we get to 2%? I don't think so. And if the market continues to hold up like this, if you really think the market's going to hold up like this, and we're going to be up, say we're up 4% in March. We're up 4% now. So if the market's flat in March, up 4%, do you really think the Fed's going to stop raising rates? Do you really think that they're going actually to totally reverse and start cutting this year if that's the case? I mean, they're looking at the markets and they're remaining resilient. It's going to give them the okay to continue to raise, because that's exactly what they said they're going to do, whether you agree with it or not.
Yep, that's a good point. Money is emotional, investing is emotional. If you feel like you're missing out on this rally, and you shouldn't be completely missing out because you should always have some quality longs, to put this in perspective, I think you just did a good job. You have to think through that. And it's easy when you just read a headline like, oh, okay, CNBC, I just saw that. Oh, Microsoft will lay off 10,000 people. Okay, now it's all priced in, move on. You have to get out of that mindset, because if you think where we're at right now, here's a snapshot, Frank. We've had a little rally. The S&P 500 is right around the $4,000 level, 4,000 mark. That is a handful of Wall Street Bank's target for the end of 2023. Now, smartest guys in the room, and not everybody gets it right. They don't have a crystal ball. I don't mean to be arrogant here or abuse them. I'm simply pointing this out to help you put this in perspective. The smartest guys on Wall Street, several of them, think that we are trading right now where their target was at the end of last year for this end of this year. Well, what that means is you're going to have a lot of volatility up or down to get back to that if they're right.
Yeah.
Think about that. The smartest guys in the room were already at their targets, a lot of them, other than Morgan Stanley, Mike Wilson, I believe his name is, who thinks, it's going to tank again.